Thinking about building your dream home from the ground up, the construction loan process can seem overwhelming, but today I'm going to break it down into 5 clear steps so that you know what to expect and how to move forward with confidence. Step 1. Find a construction lender and get a lending commitment. First off, there's never only one way to do things. But if you've never built a home before and your project relies on a construction loan, you need to find a good lender partner. Get this part secure before you talk to builders or an architect or even a designer. You need to know your borrowing power and what kind of construction loan fits you best. Realize that not every lender offers a construction loan. Most banks or mortgage brokers can't offer them because they don't have the product or they don't want to offer it. Construction loans are more time consuming than most loan officers have for the time and too complicated for most lenders to want to deal with. A construction loan is typically a hybrid loan. It's a single loan that is broken down into 2 phases: a temporary loan that converts to permanent financing. Now, within that framework, there are many nuances as to when the borrowing actually begins, but the first phase of the loan, the temporary portion, is broken down into stages. For example, the first draw may follow the foundation, the second follows the framing, the third follows the mechanicals, then the exterior and interior, followed by the trim, and so on. It's important to understand the bank is not going to give you all of the money up front. They're going to fund the loan according to work completed or materials installed. Hence, the importance of a draw schedule and a budget and a cost breakdown. We'll get to that later. As I mentioned earlier, the preferred format for the loan is a single close. Construction loans do not have to be a single loan. They can actually follow the same format, but can require 2 loans or a 2-time closing. A closing on the temp loan that is then followed by a closing on the permanent loan. Sometimes there are advantages to this setup, but think about it. You're qualifying for 2 loans, which means twice the paperwork, twice the closing cost, twice the appraisal evaluation, and twice the aggravation. There are times when this may work for most people, but it's an inconvenience for a lot of them. Since the money's doled out over time, the balance on the loan increases over the construction period. Therefore, expect interest-only payments during the temp loan stage, as the following month the balance will increase and create a higher bill. Regardless of the term you request, the payments do not include any principal. Principal payments are delayed until the permanent stage. If all this makes sense to you, after the temp phase, the loan works just like any other mortgage. You repay the debt. So aim for a 680 credit score or higher so that you can qualify for the max financing, meanwhile get the lowest rate. Construction loans are riskier loans, so expect the rates to be higher than the traditional mortgage. Likewise, lenders like to see 2 years of income history and the ability to document it. Also, your dream home will not be completed for another year or maybe more, so you'll need to live somewhere during the interim. And that expense currently involves a mortgage or another housing payment. You may be required to qualify for 2 loans or 2 residences at the same time, which can be stiff at this stage. Like any other loan, having ample reserves can help you close the deal or remain flexible if there are cost overruns during the build, which is common. Step 2. Finalize the plans and pick your builder. Next, based on the idea that your approach lender first, you'll need a set of plans and specs. Some firms offer design and build all in one stop, where you can get all of your architecture, your design, your engineering done at the same outfit, the same place as the build. Some builders may only perform that and have recommendations, lender included. So before you can actually close your loan, there will be a builder needs list that'll contain all the design elements of the build and the description of what materials you're selecting. Your lender isn't funding a dream, they're funding a detailed project. Beyond the budget, the lender will require a cost breakdown, an itemization of all the expenses of the project line by line. Allowances are okay, but lenders don't like estimates for any portion of the build. Lenders want to see matching numbers for your cost breakdown and the contract so that they can feel confident how much capital you'll need to close and what the home will need to appraise for. I've seen a lot of requests for owner builder, which can work for some lenders, believe it or not, but more often or not, it's not an avenue. Lenders like licensed contractors with experience, and if you're requesting an owner builder, be sure to have your ability to document your earnings and your experience. And just like everything, reputation matters. Request past project references, timeline adherence, which makes sense. Your money's on the line. Builder reputation matters. Past projects, references, all of that is important. And here's a builder's needs list for all the minimum documentation you're going to want to have for your lender. Signed contract, plans and specs, cost breakdown, builder questionnaire, description of materials, and copies of all the invoices and payments for any soft costs. Step 3, close the loan. Once you have everything from your builder, you can turn it back over to your lender for approval and complete the appraisal. Depending on the size of your loan request, the lender may require 1 or 2 appraisals. The value of the build is based on what the home would compare for in the market today. It's not future value. The appraiser will need to compare your home, its design, and the material list to comparable homes that have sold and closed recently. Like any appraisal, it should have a like home, one larger, and one lesser in square footage. What they like to say in the business as bracketed. Like traditional mortgages, lenders want to lend you the money based on the lower of the cost to build or the appraised value, that which is lower. However, this can depend on the equity you have in the land when you acquire the parcel. Loan closing commences like any other loan, with the exception that you may already own the property. Your builder may request a draw if they don't have a deposit or if they need an advance for custom materials or need to prepay funds for certain items like window packages. If you have a draw at closing, that means a month later you will have a payment, your first interest only payment. If there's no draw, you may not have payments until that first inspection is completed following the funding of the first draw. Step 4, build the home and the draw process. Construction begins, but the money isn't handed out all at once. It's released in a series of draws that are progress based. Funding set up based on stages. For example, the foundation, the framing, the mechanicals, the drywall, the exterior, the cabinets and finishes. Typically, the lender will not perform the inspections. Those can be done by the title company or even an appraiser. Before funds are released to the builder, the property must pass inspection. Lien waivers are collected, titles updated, and the builder gets paid and duplicated with each round. Sounds easy. So why are these loans considered high risk? Well, one of the many reasons is the cost to build a home. Since the pandemic, most builders choose to work on a cost plus basis, meaning that the builder is going to charge you the actual cost plus a margin. This way, if the cost increase, then your budget will increase and may require additional capital from you, not the lender. If you don't have it, the project may stall. It's typical for change orders to be requested along the way, which may increase the cost or may force you to eliminate another part of your budget along the way. During the pandemic, we have extensive back orders of materials, huge cost increases, and as a result, many homes didn't get to the finish line on time, which added to the cost or increased the cost itself, forcing owners to make tough decisions. Like all business arrangements, communication between the lender, the builder, and the title company are critical. Lenders and builders are a bit more specialized, but title companies are a partner you can't overlook for their experience. They keep the project flowing and help eliminate delays. Step 5, convert to a permanent mortgage. Finally, all the dust settles and it's time to move in and turn that temp loan over into your permanent financing. If your lender offers a single close construction, That's the best one because there's nothing to do. Your loan will flow over from interest only to principal and interest payments. In this case, there's no need to requalify or appraise the property because the draws are extinguished. If you have a two-time close, you'll need to refinance the balance of that temporary loan into a permanent loan. There's a lot of risk to this part as rates may have increased since the inception of the temp loan. Finishing and delivery of the home can also be delayed, so sometimes it's hard to time the second loan. It's another reason why the double close is so complicated. Locking a rate with the same or new lender may be tricky. If the second appraisal comes in lower than your first one when you started, well, that could require some additional capital on your behalf. And if you had overruns that required more money than the start, that could put you in a bind. Last, another reason I prefer the single close is at the ending, the balance converted over to principal and interest payments. If you added a contingency to the budget and you didn't need the extra money, or if you even stayed below the budget, the new payment will be adjusted to the final loan amount. Likewise, if you self-funded the last draw or sold your home and have capital to roll over, you can do it at the conversion phase. Building your dream home doesn't have to be intimidating, especially if you break it into steps. If you're thinking about building or have questions about getting started, let's talk.